Good afternoon, REEP investors and apartment investors. My name is Jacob Garza, and we would like to welcome you to our REEP Huddle. And today I've got
Hi, I'm Rebecca Trainer, the Director of Investor Relations here at REEP Equity. And we want to thank everyone for joining us today for this very first REEP Huddle of 2025.
Boy, that's exactly right, Rebecca. And we have a very good huddle today. We have the subject of the difference between investing in traditional multifamily and investing in a debt fund. So we're going to talk about the differences between the two on those. So, Rebecca?
Absolutely, Jacob. And before we get started with today's topic, we just want to remind everyone of these REEP Huddles. What are they? I think it's that John Goodgame song of "Put Me In, Coach," and these huddles, while they are informal and you get that sports reference, we wanted to start these monthly Zoom calls over a year ago, in which we invite you, our investors, to join us live and join us for just an informal conversation on a variety of topics. They've allowed us to educate our investors as well as learn what topics interest you the most in making your investment decisions. And with that being said, if there are any topics you want to learn more on, please drop those in the chat and stay tuned. Your topic or what interests you could be one of our 2025 future REEP huddles. Additionally, if there was anything you want to learn more information on, please let us know, and our team will gladly direct you to our REEP Knowledge Center on the REEP Equity website, where you can learn more. And looking back at all the REEP huddles we did in 2024, Jacob, do you have a REEP huddle topic that was your favorite or that was most interesting to you?
Yes, in fact, I do. And it's a topic that when we first started planning for, we just didn't know how much interest it would gain. But it happened to be our topic that was not only the most registered for, that was the most watched, and I believe it was the most rewatched on the recording side. And that was the one of K1s. Yeah, who would thought would be interested in K1s? But when you peel the onion back, people, it's kind of like the old with the old saying, the old ant you have in the closet, everyone's there, no one talks about her. It's an old Ross Perot joke.
Yes.
But yeah, K1s, it's an interesting topic. No one really knows much about it, or certainly how to break it down to something that's just very, very easy to understand. And you and our director of finance, Matt Swanson, did a fantastic job on that last year. In fact, I know we're going to bring it back. Do you know when, Rebecca, that's going to be up?
I would have to say definitely April or May timeframe. Now, investors, don't get scared. Of course, we're going to talk about K1s in April or May, but K1s are still on track to be delivered, of course, on time, February, March timeline, as mentioned in your email. But I think it's always great to talk about, not only things as you can call it mundane, but things that are so important in that investing decision, and the process of not only making the investment within that first year, but of course on an ongoing basis, getting those annual K1s and really understanding them to put together your entire wealth and investment strategy. And going a little bit to pivot to today's topic, this is rather timely as REEP actually kicked off our second debt fund last week. Jacob, you and Arlene actually held our investor webinar for this 506C webinar last week. And many have asked the differences of why a debt fund instead of our normal multifamily property syndication. And so we thought this REEP huddle, of course, would be not only useful for our investors joining us live, but really to understand the differences of the investment, what the returns look like, and really going into detail how both can be a part of your investment strategy. And Jacob, before we started the REEP Income Debt Fund, of course, it's on its second iteration right now, but what was your experience in this either private credit, if you'll call it, or lending world?
So, if you recall my background, I was able to have pretty decent exit, and back in the early 2000s, late 2000s, and we were able to place some significant cash in CDs. And while those are good investments, our capital certainly wasn't growing, and that is, in other words, if you put $100,000 2 years later, you still have $100,000. So um, multifamily gave us an enormous upside on appreciation for our dollars. So our money was really working at that point. And it was an asset that we all know and familiar with today, which is it gives you the ability to see it. It's not sitting in Wall Street somewhere. It's in a gray area where you have growth on income, and you typically know the sponsors that you're investing the money in. And then, of course, the tax advantages that you have all between them. So that's proved to be very good for us. Rebecca, you talked a little bit about our debt fund. So as we continued to grow our portfolio, it became um, important to us that we diverse our investments. And while we still have significant, as many as our investors do, in traditional apartment real estate syndication, we're also we can also now invest in a debt fund. And that is very similar to a CD. It offers less risk because where it sits in the capital stack, and it pays a whole lot more than 4 and 5%. The one we have is, what's it paying, Rebecca?
It actually pays between 10 and 12% based on your investment amount.
Yeah, in fact, we are on our second debt fund, and the last one we closed was March of 2024, I believe.
It was.
Mm-hmm. Yeah, and that one's done very well.
It has. You're exactly right. So that, of course, as Jacob mentioned, our first debt fund closed March 2024. We started distributions soon after. And of course, those monthly distributions, they've just keep coming in. It's nice to see that consistent cash flow on a monthly basis. We'll get to it much later on. But really, of course, with the first fund and bringing back this second debt fund, our investors really like, of course, that consistent passive income, and we're excited to offer this again.
Yes, in fact, we brought the first debt fund uh, because people, or I should say businesses that own multifamily properties, needed short-term loans. And a debt fund that's what this is. It's actually a loan. Uh, and we invest in properties that are in very good areas that REEP is familiar with. We invest in properties that are performing extremely well. We invest in properties that can really show a case study that the need is there for a short-term loan, and they're able to meet the obligation to pay it back. So it opened up another area, and we've been able to place this income or these loans, if you would, these investments with these properties and their sponsors, and it's just worked out very, very well. So fast forward a year later, and the need is grown even more in that area, and it's just a good way for you to diversify your portfolio to have what we consider more traditional equity investments in multifamily, but then also maybe have something a little more shorter term that sits a little bit different in the capital stack and still provide you a very good return of your investment.
Absolutely. And without getting into any further detail on this second fund, Jacob, let's look at a slide our team actually put together, further illustrating these differences. You mentioned, you touched on a couple. But of course, these really show the differences of investing in that traditional multifamily syndication
Mhm.
and of course into a debt fund. And so it looks like our team is sharing slide now, but you should be able to see the two columns. Now, Jacob, you want to talk about our typical multifamily investments? What I'll say has been the bread and butter of REEP and will continue to be the bread and butter.
Absolutely. So you can see there the traditional multifamily investment. It is a little bit longer hold time on that. The IRR is north of 15%, more along the 19-20% range. Um, the distributions start a little bit later in this longer term investment, but you have all the tax benefits that you have uh, that traditional equity investments that hold. So that's pretty much the multifamily investment side of it.
Absolutely. And there's still some really great benefits you will see. And of course, our REEP investors joining us live, the tangibility
Mhm.
of an asset. It's something that people often forget as a limited partner that this is it's an actual property, an actual business. I always am reminded of how passive investors can be
Mhm.
anytime we are driving around town, call it San Antonio, Houston, or Austin. Myself personally, with my husband, I say, hey, we're in town or we're around the corner from one of our LP investments. Do you just want to drive by to see the property? And he says, no, why would I? We get the quarterly checks and ACH payments just fine. We don't need to see the asset. And it's true, as a limited partner, that's one of the joys of having that passive investment in multifamily. Let's see, we talked about one thing, Jacob, I want to also touch on with our multifamily investments. These are typically illiquid, so they are not redeemable. And this is important to understand as you plan your investment strategy, to know that these investments aren't like the stock market, where you can buy one day,
Mhm.
watch it go up or down, and then sell it the next. Multifamily investments, and as well as most limited partner investments and private placement memorandums, those are illiquid. And so they are held at the asset or held in the deal until the property is sold or there's some type of capital event. Compare that, though, to a debt fund. And here we're going to talk both on debt funds in general, but also on our current REAP income debt fund too. There was a quote I recently found within my email comparing, of course, the two multifamily investments or syndications and debt funds or funds in general. And I wanted to share this with everyone. There's some really, I think, valid points of it, but it says if you're looking to make a concentrated bet with more risk and potentially a higher reward, look for syndications. But if you're looking to grow your assets with lower volatility, more diversification, look for funds. Now, there's benefits in both. Of course, we've talked about all the multifamily investment benefits, and we'll, of course, touch on all the benefits of a debt fund. But I thought that was such a succinct
Mhm.
way to say the appreciation side on the multifamily investment. Of course, huge benefits there, as well as some more immediate benefits like those tax benefits. But with the debt fund, it's about that consistency and being that diversification within your investment portfolio. And so, as you can see on the screen, the debt fund typically, I say shorter than multifamily investment term or syndication or fund. But on this second debt fund, REEP is having, it's a 5-year term. And unlike the illiquid syndications, this will actually have a redemption option that is available after the 2-year point. And this is important because I think many investors are looking for that flexibility and trying to see how best it could fit in with their overall strategy.
So Rebecca, as you mentioned on the multifamily fund, it's an illiquid asset, and it basically resides in one particular property. You know, your investment is pulled together to buy one apartment complex. So the debt fund, it is redeemable after a couple of years. You can um, request to get your principal back. Is that with that, right?
That is correct. Yes.
And also the term fund means uh, the the fund will invest across multiple assets and make multiple loans, hence the word fund, and kind of mitigating some of your risk being in one property. Is that kind of how to say it as well?
It is. And people talk a lot about, I know we've said it a lot as well, Jacob, diversification. Not only diversification from outside the traditional stocks, bonds, 401ks, CDs, diversification into these private equity investments or private entities, but also within your investment, having that diversification. We've had several two-prop, I call it portfolio syndications, and that's why we do that. It is to offer that diversification piece within a syndication. Now, within a debt fund, it's true again, the diversification amongst several properties or several loans, of course, to these multifamily properties, of course, offering that diversification piece. And typically, of course, where you see higher diversification, lower risk. And so we really like to add that diversification piece to this debt fund. And I know we talked, Jacob, on that passive income. And I'll say distributions, diversification. There's a lot of, we call it alliteration, or we love the diversification and we love those distributions. Now with the debt fund, this of course is monthly distributions starting only 30 to 60 days after the fund closes. Now this was not only true with the first fund, but the second fund as well.
Yes.
And so with that, investors really do like, of course, the monthly frequency instead of the more quarterly distributions that are in a multifamily investment. And some people may say, well, why is it so long after you close a property? You know, I have to wait 3 to 6 months to get that first distribution. Well, with real estate, we know this is, of course, a long-term investment. And we know that once we take over a property, there's a lot of work that our teams get done exceptionally well, but it does take time to, of course, see our business plan to fruition and be able to get things up and running. And so the debt fund, of course, certainly offering more diversification and more quicker timeline for those distributions to occur. And related to those distributions, it's a preferred return in this debt fund. It acts, Jacob, like an interest payment. Can you explain a little more on that?
Certainly. So let's just take, for example, you have an operator that has received from the taxing authority a refund. This is very common. The lender has been escrowing and has been over escrowing on taxes So let's just say they're going to get $500,000 refund uh, back from the county. Um, in that particular instance, this decision will be made probably coming up like February or March is when taxing authorities typically reconcile their uh, previous year. So they will let the owners know. That's the good news. They're going to get a tax refund. Bad news is they don't get it till November. Um, and so it's very illiquid for a period of months. This is where, the debt fund would come in and uh, loan temporarily the, um, the property or the sponsor this particular amount of money. Uh, so without getting into the details, is basically this pledge coming back from the county, which about as good as it gets coming back from the county, uh, would be refunded. So those are some entitlements that are actually forged in agreements. So that's where that particular um, asset is uh, being paid back. Now, the interest in the meantime is paid through the property. And this is where the interest payments are basically like distributions. It's a preferred return. And we're able to put these payments just after the mortgage payment. So the sponsor, again, these are very well-run properties, are performing well. So as soon as the mortgage payment is made, well, our interest payments on the debt fund are made. And I think that's why you've seen some of the success that we've had on this particular investment instrument that goes out.
Absolutely. It certainly is. Um, Touching just on those last couple of bullet points on the slide, we've talked a lot about the diversification, and Jacob, you even touched that's on the seniority within the capital stack, that priority payment. It's ahead, of course, of any equity or promote within the capital stack. And so it certainly has many, many benefits of a debt fund to add within your investment portfolio. And Jacob, would you say there's any other differences or anything we may have missed in talking on the traditional multifamily syndications and debt funds?
Thanks for asking that, Rebecca. No, they're very different in many respects. At the same time, they all fall under the real estate umbrella. So the level of certainty that you can rely on and of why you invested in real estate to begin with holds true with the debt fund because it is real estate, and that is something we're very, very familiar with.
Absolutely. I love it. And on this next slide, our team also made a great representation, of course, and this is true not only for the debt fund, but of course also for multifamily syndications. If you have those old 401ks or IRA accounts, just, really sitting around, but also seeing the volatility of the traditional investments like the stock market, and wanting to diversify again, part of that further, you can, of course, redirect your retirement funds into multifamily, whether it be a syndication or a debt fund. There's very, very, I say, simple steps, 6 that are listed here. But of course, please feel free to reach out to us if you are interested in investing your IRA. We'd be more than happy to assist, as well as share our recommendations on IRA custodians and what is going to be best for your investment portfolio. And one thing that we talked on in the very, very beginning, how mundane topics like K1s can be. Well, here's another a bit mundane topic, and that is UBIT. For all of the IRA investors out there, I'm sure you're familiar with this term, but this is the unrelated business income tax, or also referred to as UDFI, unrelated debt financed income tax. Both, of course, are a part of just normal taxes that IRA investors have to comply by. Now, with a debt fund, we do want to mention that IRA investors, because it's a debt fund, but there's no leveraged or debt on an asset, there's actually no UBIT within the debt fund. And so that's another added benefit I think we forgot to add on that last slide of investing in a debt fund. And so it's important to understand that, but we also want to educate our investors of course, all of the reasons and, of course, what these IRA investments look like beforehand. And of course, it would be amiss if we did not share the recommended just further resources that we have on the REEP Equity website. Here on the next slide, we have just a list of some, but certainly not all, of those resources that you can access at reepequity.com/resources. I have to brag on our team, Jacob. Our marketing team has just put together a wonderful source. You can really get lost in it. I'll say in a very, very good way. There are a ton of resources out there, and we want to best equip not only you as our investors, but everyone as it relates to investing in multifamily.
And they've done a very good job of setting this up depending on the level of discovery that you're on. You could be talking with someone and they may ask you about your investments in multifamily, and you can direct them to there and they can start literally like knowing anything. At the same time, you can also be talking with someone who's maybe has some investments in real estate. They want to know more about how we do it, and they can take a level of sophistication and just kind of move them up from there. So you're right. They've done a very good job with our library and putting together different types of resources to answer the questions on apartment investing.
Absolutely. And we've seen some great questions come in. We welcome, please input more of those. But before we get to all those questions in the chat and the Q&A box, we want to invite everyone to our next monthly REEP Huddle. This, of course, is very timely, and we hope you'll join us on Wednesday, February 12th. That is the week of Valentine's Day, which is very timely as the topic is on building your legacy of love. Jacob, you'll be hosting this with Arlene, and you can scan the QR code on your screen to register for February's REEP Huddle. We look forward to seeing you there. And let's see, I see some questions in the Q&A. This first one, Jacob, I'm gonna direct to you, but the question is, can you be more specific regarding what assets Fund 1 has invested in, what location they're in, and how will Fund 2 investments differ?
Sure. So I'm going to say that regarding the asset, that's the apartment community. Is that what the question is?
Correct.
Yes. Okay. So yeah, these funds will be invested directly into what REEP is familiar with, and that is apartment communities. We don't invest outside of that. Just take it a step further. We are familiar with the location. They need to be in the Houston, Austin, San Antonio area, and we are looking in the Dallas area. We have resources there as well. But those are the areas that we invest in, and we're very familiar with the assets that they go into.
Great question. And one thing I don't think we covered in today's huddle, but I know you and Arlene had mentioned a lot about on, of course, the webinar that we had, was the criteria that we look for before we lend or deploy these funds out of the debt fund into a project. What we do in the analysis beforehand to make sure that these properties will meet, of course, the interest payments and principal paid back. Do you want to share a little bit more about
Certainly.
that?
Yeah, thank you. So it all starts with the people we're going to loan the money to at the end of the property. There's always a guarantor. There's always someone, a sponsor. So they have to set right with our values and their track record. We typically like to see 3 to 4 full cycle deals with them. Number one, property performance. It has to be in the right location, it has to be performing correctly and performing right in order to pay the interest on that. Third, there has to be a clear reason to loan them money. It has to make sense, has to fit the business plan. And number 4 is the exit strategy. How do we plan to retire the principal on this? So those are the 4 factors that we look at.
That is very nice. And it's almost as, I certainly don't want to say it's as thorough as our own acquisition criteria, but it still seems to be very thorough in our analysis before we deploy funds.
Yeah, that's another good question because prior to buying a brand new multifamily asset, we can't exactly go and ask the asset manager specific questions about the property. We don't own it, and they're going to sell it to us. And when we sell a property, they don't ask us specific questions either. It's that dynamic of how selling and buying work. In this particular instance, because it is an asset, we can walk on their properties. We can talk to the management company. We can talk to them very specifically. So it's a little more due diligence on the front end for us before we invest.
Absolutely. And there's some more great questions on IRA investments. I see the first one is, what about SDIRA and UBIT taxes? We did cover that. Of course, multifamily syndications that have a debt leveraged property or asset, those of course incur UBIT. It's on your Schedule K1. And what do you think about EQRP? EQRP we have worked with before here at REEP. We do have, of course, some of a handful of IRA custodians and 401k custodians that we can certainly recommend to you. If you'll just reach out to us at invest@reepequity.com, we'll certainly get you that list. The second one, though, SDIR, I assume self-directed 401ks. This is a great point. If you have, of course, and you are the custodian of your 401k, there are, of course, other vehicles to still self-direct and have those retirement funds retain their tax shelter while still being able to invest in these alternative assets or private equity funds, things like that. I'll say for 401k custodians and things like that, please feel free to reach out to us and we'll be glad to help. I see just a few quick questions in the chat as well, also related to IRAs, but I think that are helpful to understand and helpful to repeat, of course, for the entire audience. Now, investing, of course, with those IRA funds, making the funds, of course, through your self-directed IRA custodian, and then as those distributions begin, those funds will go back to your IRA account. Now, of course, if they went to elsewhere to your bank account, that could disqualify not only the tax shelter in place for those distributions, but of course your IRA account overall. And certainly for investment vehicles like a Roth IRA, this could have, of course, some major consequences that you want to avoid. And so here at REEP, we will send those distributions directly back to your IRA custodian, as well as any type of, I say, annual paperwork or requirements that your IRA custodian needs and has, we will certainly take care of as well.
Okay. Any other questions, Rebecca, you see?
Let's see. I don't think there are. But we just, again, I want to say thank you to everyone who is joining us live for our first debt or for the first REEP Huddle on the differences of debt fund and of course multifamily syndications today. We certainly look forward to having you a part of more REEP Huddles in 2025. And I just want to thank, of course, excellent co-host of today's REEP Huddle, and of course the host of next month's REEP Huddle as well, um, Jacob, for all of his time and of course supporting these monthly REEP Huddles as well.
Yeah, I enjoy it too, Rebecca. You're great to sit in front of the camera with, and you always come prepared. So thanks for everything.
Well, thank you, and thank you again for joining us today.